The stock market is like a roller coaster, full of highs and terrifying lows. But what if I told you that crashes can actually make you rich? Sounds crazy, right? Well, here's a shocking fact. Investors who bought stocks during the 2008 crash made an average of 8 times their money in the following decade. And that's not an isolated case. The market has always bounced back, and those who kept their heads cool turned huge profits. But here's the kicker. Most people panic and sell when the market dips, losing money instead of making it. You don't want to be one of them. In this video, I'll show you how to think differently and take advantage of market crashes. You'll learn how to spot undervalued stocks, build a crash-proof portfolio, and use patience to turn fear into fortune. Stick with me, and by the end, you'll have the tools to profit when everyone else is freaking out. Let's dive in. Chapter 1. The Panic Playbook. Why the stock market loves fear. When the stock market crashes, fear takes over, and it spreads like wildfire. Investors panic and sell their holdings at a loss, believing the sky is falling. But here's the secret. The market doesn't always reflect the true value of companies during these times. In fact, when fear drives prices down, it creates golden opportunities for those who can keep their cool. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." The Panic Playbook is all about recognizing that fear often makes stocks cheaper than they should be. Remember, crashes are temporary, but solid businesses can survive and thrive. One of the most interesting facts is that after every major market downturn in history, the market has always recovered. Investors who buy during a dip often end up reaping huge rewards when the market bounces back. For example, in 2008, the S&P 500 lost nearly 38% of its value, but by 2013, it had more than doubled in value. Chapter 2. Crash-proof your portfolio. The power of patience. The key to thriving during a crash isn't rushing to make quick moves, but practicing patience. Value investing is about buying solid companies at a discount, and it takes time. Patience isn't just a virtue, it's the foundation of wealth building. Legendary investor Charlie Munger once shared, "The big money is not in the buying and selling, but in the waiting." The longer you wait, the more opportunities you have to purchase undervalued stocks at a bargain price. According to a study by Vanguard, long-term investors who held onto their stocks for over 10 years averaged 7-8% returns annually, regardless of market downturns. In fact, some of the best investments you can make today might look unappealing to others, but over time, they'll prove to be wise choices. The market crash is like a sale, but only for those who have the patience to wait for the right moment. Chapter 3. Buy the dip or buy the whole market? When to go all in. So, should you buy the dip on individual stocks or dive into a broad market index fund during a crash? The answer depends on your strategy and risk tolerance. Buying individual stocks requires doing your homework to ensure you're selecting high-quality companies that are temporarily undervalued. Look for companies with strong fundamentals, such as a low price-to-earnings ratio, (PE), or strong free cash flow. On the other hand, buying an index fund, like the S&P 500, spreads your risk across many companies, ensuring that if one or two stocks underperform, the others will balance out. Over the last 100 years, the S&P 500 has returned an average of 9.8% per year, making it a solid option for many long-term investors. During market crashes, buying the whole market can be a safer bet for those who don't have the time to research individual stocks. But for value investors, handpicking stocks can lead to much higher returns if done right. If you're finding this content helpful, don't forget to subscribe and hit the bell icon so you never miss a strategy that can help you build wealth during market crashes. Chapter 4. The 3 R's, research, risk, and rewards. Maximizing your gain. To turn a market crash into a wealth-building opportunity, you need to focus on the 3 R's, research, risk, and rewards. First, research is your foundation. Don't just blindly buy stocks because they've fallen in price. Analyze financial statements, understand the company's competitive advantage, and look for consistent growth. Second, managing risk is crucial. You must decide how much you're willing to lose in case things don't go as planned. Risk management tools, such as stop-loss orders, can help protect your investments in volatile times. The third R is rewards. Value investors who put in the work and manage their risk can often see huge returns. According to a 2020 report by the CFA Institute, investors who bought undervalued stocks during the market crash of 2020 saw returns of 35% by the end of the year. Those who got too greedy or acted too fast without proper research saw far smaller gains. Chapter 5. The Hidden Gold Mine. Undervalued sectors to watch during a crash. Not all sectors react the same during a market crash. While tech stocks might take a hit, industries like healthcare, consumer staples, and utilities often hold up better during downturns. For example, during the 2008 financial crisis, healthcare stocks proved resilient, as people still needed medications and medical care no matter what. One interesting fact is that during the 2020 crash, the healthcare sector rebounded by 14% while the overall market was still struggling. Similarly, dividend-paying stocks in consumer staples like Procter & Gamble and Coca-Cola also tend to weather the storm better. Value investors who focus on these sectors may find a hidden gold mine in the midst of a crash. Keep an eye on industries that are less affected by economic cycles and have long-term growth potential. Chapter 6. Master the Crash. How to turn volatility into your profit machine. Market crashes can feel chaotic, but for a savvy investor, they're simply another opportunity to make money. Volatility is your friend when you have a well-thought-out strategy. One powerful tactic is averaging down, buying more of a stock at a lower price as it declines, which reduces your overall cost per share. This approach works best with companies you believe in long-term. According to a study by Morningstar, investors who used dollar-cost averaging during the 2008 crash saw a significant advantage over those who tried to time the market. Another strategy is to reinvest dividends. By doing so, you buy more shares at lower prices, compounding your returns over time. In fact, a 2021 study by J.P. Morgan showed that reinvesting dividends can increase your long-term returns by up to 2% annually. Finally, remember the importance of having a margin of safety. If you buy a stock at a price significantly lower than its intrinsic value, you reduce your risk and increase your chances of success. It's all about keeping your emotions in check and sticking to your long-term plan. If you found these strategies helpful, make sure to subscribe for more actionable tips on investing. Together, we'll turn market crashes into wealth-building opportunities. Conclusion: a stock market crash isn't the end of the road, it's an opportunity to grow wealth for those with the right mindset and strategies. By staying calm, practicing patience, and doing the proper research, you can navigate through the turbulence and come out ahead. The market will bounce back, and the investors who take advantage of the fear-driven discounts will be the ones who reap the rewards. So, next time the market dips, don't panic, get rich instead.